Good evening. This is Ken at Tortoise Capital with a review of the weekend trading report for August 2nd, 2019. Market is in bullish normal conditions. We've adjusted the NDX indicator, the market summary here. We're now looking at a series of look-back time frames on daily charts, 3, 10, 30, 90, and 270, reflecting our fractal approach. This aligns things with the way I'm actually conducting support resistance analysis and trade location analysis, and it links up nicely with the regression line fractal framework timeframes. We have a market that's overbought still on the long-term 270. That's just about an annual. A 90-period look back is roughly a quarter. 30 is a little over a month. 10-day is a 2-week, and I'm calling a 3-day look back a cycle or a short-term psychological cycle. And you can see we're neutral on the quarterly, and we went deeply oversold on 3 through 30 period look back. I like the feel of this thing already. It gives a sense of where we are psychologically in the minds of people whose primary time frame are those decision cycles. In the market mosaic, we're still white bullish with price respect to the 200. The risk index dropped down into risk off conditions this week with a score of 0.972. 1.0 is a boundary between risk on and risk off. That's computed by finding the 30-period moving average of the VIX divided by the 10. The risk Z is a 5,000 period look back and then finding the average and standard deviation, then computing the Z score, and that's at minus 0.41 or 0.41 standard deviations below the very long-term average. You can see that 90-day histogram. We just entered the winter, so this is a time to shorten up our time frames, emphasize the short-term intraday volatility moves. Be very certain that you have a sensible swing trade if you're going to initiate them here, but you can also be thinking about swing trade short positions on very weak sectors or even using volatility. Blended monthly rebalancing, you see the current holdings for August. Next re-evaluation on or about 1 September. Leaders going into the weekend here. And then theoretical exposure of the market model on ETF2 is down to 20%, with most of the symbols being on sell signals. Blended monthly rebalancing portfolios, you can see the 13 and the 22. We're up to about 50% cash or holding. This is based on price with respect to the 4-month moving average. I can see the leaders. Treasuries and real estate are the defensive plays, and even consumer staples. And then technology, simply by virtue of how strong it's been over 3 and 6 months. But you can see that tech got smashed this week, along with consumer discretionary. Latin America and emerging markets also suffered. Just about everything was bad except for these defensive plays here, treasuries and U.S. real estate. So that's a shift in asset allocation. 32 ETF portfolio, the same thing, only a little more detailed. That takes the 22 ETF portfolio and then adds a few more granular ETFs. The Dow 30, even the winners got assassinated this week, but notice that the weekend really got crushed. So things like Cisco, Intel, Nike, Pfizer, Caterpillar. So this was the worst week of the year. The Dow was certainly hurt, but there was a little more residual strength in those elements that had been outperforming. So you notice that from extreme conditions come extreme performance. So it pays to know who the relative strength leaders are. Sector spiders. Detailed look at the U.S. sectors. Again, the weak areas got smashed the most. So telecom, metals and mining and retail, treasuries, real estate. You can see the defensive plays are predominating. The broad ETF max, this is looking at 300 or 400 ETFs and then ranking them by blended return. And we're looking just for the absolute relative strength winners. You can see gold made another strong move. Treasuries, though, long-term government bonds, any form of treasuries. ETF2 regional, 2 out of the 10 are on buy signals. That puts us at 20 and 80 in the theoretical model allocation strategy. Still bullish normal. S&P at 47, still better than the EFA at 39, so it's still the U.S. Inside the U.S., it's tech, large, mids, and smalls. Weakest sectors, EEM, emerging markets, and Latin America. Inside the sector spiders, the 9, it's tech and staples leading the way. Energy and industrials lagging. World market model, the alternative asset classes rose to the top. Pretty much weakness everywhere else, but large caps better than mids and smalls in the U.S., as we know. ETF 30. Silver made a nice run in here, being green and yellow. You don't see that often. So and then defensive plays in the bonds, good. Even dividend appreciation was beginning to give up. So white and green was great, now just good. Preserve profits, watch for a resumption in things like dividend appreciation, infotech, home construction. Shifting to the daily report. You can see what that 3-day cycle I talked about before. There was a bounce off the bottom, but still. When we look at the NDX, what we do is we are considering day -1 to day -10, and so then you can see that today's price is outside of that 10-period trading range, and that's what makes that so compelling. Cruising down towards an almost inevitable crossing of the zero line, so defensive place certainly worked. We tested that 30-period look-back support level. And if that cracks, then it's the RL 270, and then the 200 is the next level. And then the entire 40-day move to the top is negated. About half of it has been negated so far. Which started with, as spring into the summer, into the fall, it started getting problematic. There was an Indian summer. And then this long period in the fall. So we've had 12, 15 days of warning that it's not following through. And then crack 1, 2, and 3, and then a long weekend to think about it. I've adjusted the daily also to reflect. I like this already. It's just I should have done this years ago. Lots of overreactions to choose from. Dow Tactical Summary. Everything on the auto framer is awesome. Many RSI 2s in the single digits. You can see the ones that cracked below their 10-period trading range. Real strength over here in Procter. ETFs are basically the same. Everything is testing out well in the auto framer. You wouldn't be surprised by that. So this is a case where it's market condition and not individual sum of performances, right? So this is a case where the market is really dominating the situation. So you got to get that right. For those of you that have been following along with the video that we did during the live trading workshop, where we mapped out the support ladder and all the scenarios for downside weakness, you should be following right out of the playbook from that video. I mean, that set the table for some very effective trading in a routine manner this last week. Pay attention to the market and the sectors. Map out the other side of the trade, and the upside will take care of itself. So that is absolutely worth revisiting. It's in the home study courses, and I may send a link around to that again because it's that important of a lesson. The weakness from this last week may not even be over. I mean, that's really just the first wave, the first crack in the long-term view. So there's plenty of downside available if nobody steps in to buy this. Most of the Z stretches to the downside. Still a handful of pretty good compressed pinch boxes to choose from. Lots of auto framers and the regression line fractals. Now you can see that the symbols that are the most above their own RL270 now pulled back like 3 or 4 ATRs this week. That used to be 8, 9, and 10 last week. And then the deeply discounted ones, these are how many ATRs they are below their long-term fair value, so still plenty of good ones to choose from, including some ones that suffered a lot this week. So value is available. Don't be in a hurry, but frame your trade in the usual way. Lots of framing to choose from. Daily squeezes. There was nothing that tested out better than 2 to 1 simply because of the size of the moves on Friday. So that makes it very hard to get better than 2 to 1 based on range risk. But I wanted you to see that there were what the priorities were in terms of relative squeezing, using the risk that came out of this comparison of a quarter of an ATR versus range risk versus max ATR risk. So you can see that in many cases the ranges were greater than 1 full ATR, which is why the 1 ATR was preferred. So this my risk column finds the middle value of a quarter ATR, a full ATR, and a range risk. And most of the time the range risk, which is yesterday's range plus a buffer of 5 cents, is the risk that is chosen for computing the reward to risk. So we take the range stat, divide it by the chosen risk, and that's where you get this from. But notice that in this case, the range risk was almost 5 times the size of a quarter ATR. So that's more than 1 ATR, or almost 1 ATR there. But in all of these, it was more than a full ATR, and that's why that ATR was chosen. So if you can play intraday technique, you may be able to use a somewhat smaller initial risk in order to make this a more favorable reward to risk ratio. But maybe this is a position sizing risk, and then you might think about the quarter ATR as the execution risk, and then be well postured to trade well, but with managed risk in a disciplined way. So that's why I've included this listing here. Lots of springs to look at. And everything is either falling or in the winter or deep into the spring. Only one in the summer, that's treasuries. Not surprising. ADX stat. See the magnitude of that regression. And this is why I like to look at that slope of the 30-period regression line. So it was already declining, coming back to the long-term average. And then that little parabolic shows you way over in here that there was perhaps the end of this run, and now it was worried about the downside. So whichever side that parabolic moving regression line is with compared to the slope, that's how I'm reading that. That's how I'm interpreting that. We're back to the long-term average of the S&P. This looks just sort of like a leg 1, leg 2, leg 3 is now stabilized. If we were to draw that line, we'd say, yep, this is a critical point. Less than 1 SD in terms of stretch above the 200. So this is the market will be tested this week for courage. Back inside long-term norms. Volatility just introduced, just beginning to get the hook up in volatility. So this one looks at the SPY volatility defined by ATR, which is a 14-period, whereas this one uses a 30-period look back. So that's why this is slower to turn. But notice how much more wicked that volatility can be. And we've had a long period here, almost 90 days of extremely low volatility as measured by 30-day price standard deviation. The 90 is rolled over. The 30 is certainly rolled over. The 10 dropped out of the Yellow River. And we're at the bottom of the river channel here with price. So this is, again, a natural place to find support. Last time it did. It collapsed a second leg and then rebounded nicely. Now it's here. The last time it was there, it was here. Time before that, it was here. And notice how big that drop-off was. That was a $40 drop before it finally made that remarkable, almost historic move off that low from 235 to 300. So this little support low, here's what can happen. It falls out, finds support, gains, big collapse. That's why that collapsing dragon is so powerful. It made a support level here. Here it mucked around, failed. Now, so that's at least 3 different scenarios of what can happen from here. But notice it doesn't stay there long. It usually makes a move one way or the other as the new strategy unfolds. And I'll just show the rest of these for reference for those of you keeping score at home. Okay. It's Canna Tortoise Capital. Keep your risk measured and your powder dry. Pay attention to that market and the sectors. That's what guides you.